Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is John Mayer, Chief Investment Officer at GlobalX. GlobalX offers more than 90 ETF strategies with over 43 billion in assets under management in the US. So we are talking about the market outlook and thematic ETF investing in 2022. John, welcome. Thanks for joining us.
Thanks, Nina. Happy to be here.
So I wanted to start with your thoughts on the recent market action. So it's been quite a roller coaster ride this year. So tell us what you think of these gyrations.
Sure. Yeah, it certainly has, for sure. Today, the market is reacting more positively, which is nice to see. But looking more broadly, there's been a huge surge in global inflation, as well as obviously in the US, which is part of that. And that has pulled forward central bank hiking cycles and balance sheet shrinkage across the board. The Fed in the US is no longer dovish. And this has caused some concern in the market. So in the current environment, investors are faced with the likely case of higher policy rates from the Fed. And this translates to higher discount rates, which leads to lower valuations. So it's fairly simple. Higher rates mean lower valuations, mean lower stock prices. And that's some of the reason why you are seeing some shifts in the market and reallocations in terms of positioning. Now, if company growth remains stable, I think expectations could be that value-focused sectors and companies will lead performance while their growth counterparts could flounder. Now, with this earnings season, we saw divergence in growth from technology to communication names that function across different industries. So, for example, companies like Meta, formerly Facebook, and Netflix, which thrive on headcount and user counts to project their future earnings, when these companies see their subscriber base plateau or there's a reduction in subscribers and users, the market potentially and did punish them pretty severely this time. On the other hand, companies that function within the software hardware space like Google and Apple, despite all the supply chain issues and the semiconductor concerns, they've been able to show a growing business in the current environment. And the market rewarded these type of companies. So you're seeing a real bifurcation in the market, but there's a lot of positive news coming up as well. New daily infections in the US for Omicron, or COVID with the Omicron variant, have declined pretty significantly, 40% lower than the peak in January. So that's good. Cases in 5 of the major European countries are declining. They stopped falling in the UK, but they are still rising in Germany. And then some European countries are rolling back their restrictions, and many of the states in the US are also rolling back some of the mask restrictions. In New York, they just announced today, inside mask wearing is being rolled back, I think, this week or next week, as well as in California. And that will help as the economy continues to reopen and there's a re-engagement in certain activities that really haven't been doing that much of over the past 2 years. And then we moved to jobs, and the January jobs report surprised to the upside. Non-farm payrolls jumped 467,000. There was significant upward revisions in the prior 2 months, about 709,000. The labor participation rate increased. Average hourly earnings rates jumped 0.7% month over month, pushing the year-over-year rate to 5.7%, which also feeds into the inflation narrative and the Fed hiking cycle, all leading to some of the volatility that we have experienced so far in 2022.
Yes, so you mentioned rising inflation, rising rates, tightening of monetary policy. So these are some of the biggest concerns for investors. But looking at the positive side, as you mentioned, earnings were quite robust. COVID cases are declining. The jobs report suggested that the economy remains on sound footing. And as you mentioned, today stocks are rebounding very nicely. And for the purpose of reference, we are talking on Wednesday, 9th of February. So do you think the worst is over for the time being? And how should investors position their portfolios for 2022?
It's very hard to predict. Could we see another leg down? It's possible. There's certainly some tail risks. With respect to potentially what's going on with Russia and Ukraine, and how that potentially could disrupt energy markets. But the market is keenly focused on profitability. Over the past several years, the market has been fueled by excess liquidity provided by central banks across the globe. And that is not going to be the case going forward. That being said, the area that makes sense is to focus on companies that are going to be more profitable, can continue to grow, can navigate supply chains effectively in this constrained environment. Because we do have a supply issue, we just don't have a demand issue right now. That potentially could change with growth slowing. But areas that I would focus on in this current environment are cyclicals, financials. Financials are certainly going to benefit from a steepening yield curve. The Fed raises short-term rates. That's likely to happen, and the shrinking of the balance sheet likely will cause the long end of the curve to move up. It has moved up some, it's pulled back a little bit the past day or so, but still it is steepening, and that certainly would benefit financials. Energy companies are uniquely situated because the re-engagement of the global economy, and that there is a tremendous amount of building going on. An infrastructure plan was passed in the U.S., so that can act as somewhat of a stimulus over the next 10 years. Remembering some of these packages that are passed in the U.S. on infrastructure, the one that was passed, the bipartisan bill, the spend is over 10 years. Some of the projects take a long time to develop. There's very few shovel-ready projects, but the material sector could be a beneficiary of that as well. But profitability, large cap focus, value is experiencing a lot of interest, although today there's been some shift in leadership, but one day does not make a forecast.
So I noticed very strong inflows into your covered call ETF suite, particularly the Global X Nasdaq 100 covered call ETF, the ticker symbol QYLD, which is now your largest ETF with over 6.35 billion in assets. Now, the strong interest in these covered call ETFs makes sense because these have very attractive yields, and interest rates are still very low, though they have started rising a little bit. So obviously investors love income. So could you tell us how these ETFs work and how they should be used in a portfolio?
QYLD is our largest fund at the moment, and we've seen strong inflows into this portfolio, into this ETF this year. About $110 million have flowed into this portfolio this year. We believe that the increased interest we're seeing in the covered call suite overall stems from the high level of yield produced by the product. So our largest covered call ETF is QYLD. It's the Global X Nasdaq 100 covered call ETF. And QYLD has yielded about 14% or so over the last 12 months. And remembering that we're in a very low interest rate environment. And yield is quite a rare thing. So covered calls, essentially how they work, you sell away the upside potential in exchange for the options premiums that can be taken as current income. So the yield that's produced is very attractive, and that's one of the reasons that people use this in a income type portfolio. I build our model portfolios at GlobalX, and we do use QYLD in our equity income portfolio. Also, something to keep in mind, covered calls shouldn't be utilized for downside protection because there is some cushion on the downside with respect to the option premiums received, but you do experience downside on these types of products. Just generally, covered call strategies could be implemented on at our firm and beyond on a variety of indexes or underlying assets, and I think it's well suited for an income-oriented portfolio, understanding some of the risks, like getting instrument.
Yeah, these are very interesting instruments. Another area which saw a lot of interest from investors is commodity ETFs, your commodity ETF suite, and which makes sense because rising inflation is one of the main concerns for investors, and commodities are usually seen as an inflation hedge. Particularly your uranium ETF, the ticker symbol is URA, that gathered a lot of inflows. And this is a very interesting ETF, and not many investors understand uranium investing properly. Earlier last year, uranium stocks and ETFs had surged. They had kind of gone nuclear because there was a lot of interest on Reddit's Wall Street Bets forum. And uranium is mainly used in nuclear power plants, which is one of the cleanest ways to produce electricity. And so that is another reason this is benefiting from a shift towards ESG. Talk to us a little bit about commodity ETFs and which of your commodity ETFs you expect to do well this year.
Sure. Uranium, let's start with uranium, and uranium is very interesting. And I think uranium has a bad PR firm. I think they need to get a better PR firm to help them to just nuclear power in general. To put it into context, uranium fuels nuclear power, which nuclear power represents about 20% of America's energy and 10% of the world's electricity. Let's think about this. A single pellet of uranium produces the same amount of electricity as a ton of coal, 3 barrels of oil, or 17,000 cubic feet of natural gas. It's a clean energy, but obviously there's been some nuclear disasters around the world. So certainly the concern about a nuclear situation is a concern, and some countries don't want it. But on the ESG front, it really makes a lot of sense. In 2020, the U.S. government began to invest heavily in uranium mining, and this contributed to the uptick in the stock prices of some of the uranium miners. And if you look at more broadly, there's about 50 new reactors that are under construction around the world. So there's China, there's India, there's Russia, there's the UAE, and some of the completion dates are between 2022 and 2027. So there's a large need for uranium. And so in aggregate, there's about 445 nuclear power plants operating, and then 300 more are proposed in some Asian countries, where you're seeing a much needed source for electricity, and nuclear power fills that source. And it's also considered a good sign of a strong economy when nations around the world are increasing their electricity use. So uranium is trending as a way to fuel electricity. So in turn, there's the rise in electricity is fueling the demand for nuclear power and uranium. So I think there is a very strong case for uranium, particularly to be used in a portfolio. Now, with a stronger economy and economy that's restarting after 2 years of fits and starts owing to the pandemic, energy is front and center and has done very well. We have a couple ETFs, MLPA and MLPX, which provide they're MLP ETFs that provide income. So MLPA yields 7.3% 3% or so, and MLPX is 5%. So MLPA pays a high dividend to investors because they don't pay corporate income taxes, and they invest in midstream pipelines and storage facilities that potentially have less sensitivity to energy prices, but certainly have moved up with energy prices. So this space, I have a positive view on the space at the moment. They're well positioned for a rising rate environment, given MLP midstream real asset exposure and just the nature of midstream contracts. They have strong cash flow generation, and there's strong M&A activity in the space. And also higher oil prices are expected to persist for a longer period of time. So I think this is an area that makes a lot of sense right now. It makes a lot of sense because the energy space is getting a lot of attention, high utilization, and the yields are high. And people are starved for yield. So this is a really good place to be.
So yes, your MLP ETFs, the ticker symbols are MLPA and MLPX, and both these ETFs have done pretty well this year. And in addition to a very juicy dividend yield, these benefit from the rising oil prices, and many traders are now talking about oil prices going to $100 a barrel. So definitely worth a look. I was a little surprised by outflows in these ETFs because normally investors chase performance. Now, I wanted to now talk about thematic ETFs, and Global X is well known for its thematic ETF suite. You offer so many interesting thematic ETFs. 2020 was the year of thematic ETFs, and that is because of the pandemic. We all had to adapt to these new ways of working, shopping, and entertaining ourselves. So areas like video gaming, cloud computing, e-commerce, these were big winners in 2020. They lost some momentum in terms of performance last year. But thematic investing continues to grow rapidly. And I saw a recent survey by Blackwater Search and Advisory, which said that assets in thematic ETFs have grown fivefold since the onset of the pandemic. So tell us a little bit about the thematic ETF landscape and which are the most popular themes currently.
The thematic 2020 certainly was a great year in terms of performance. There certainly was some pullback in 2021 and into early 2022. But taking a step back from pure performance, thinking about thematic investing more broadly, it's a long-term focused strategy. It provides investors with the opportunity to remain invested at the forefront of technological advancement, and it provides exposure to companies that are kind of on the new stage of adoption for different technologies. And many of these companies are growing in importance and potentially becoming a larger portion of the broader economy. If you think of the utilization of many of these different themes during the pandemic, you think about keeping ourselves occupied with video games and esports or social media, doing our banking online with financial technology, being connected by the cloud. Those are all very important. Now, thinking to 2022 and beyond, some of the themes that I think make sense, particularly in our world of the digital economy, from video games and esports to financial technology to social media. The first one I want to start with talking about is robotics and artificial intelligence. In the current environment, companies are looking to increase efficiency. And through this earnings season, we saw that many companies are spending more on CapEx. For the S&P 500 companies that have reported so far, that there's about a 38% year-over-year increase in CapEx. What that tells me is that companies are looking to increase their efficiency. We know that labor costs are rising. We know that the concept of automation can't just be put in place day one. But we know that the labor force is requiring higher salaries, and owing to changing demographics, labor continuing to be in short supply over time. That being said, I think this theme makes a lot of sense. And robotics and AI sits at the crossroads of multiple structural trends that are expected to increase adoption over the coming years. So rising inflation, as I mentioned, supply chain disruptions, and deglobalization. So over the past few years, the world is attempting to deglobalize, where globalization was occurring over the past 30 plus years. We also have the aging population. So firms are exploring solutions to enhance their efficiency and reduce their costs. And as the technology increases and automation becomes even more possible, cheaper, and easier to implement, and companies are thinking that reshoring is likely and will accelerate as there's benefits for having production more localized. You're reducing your cost in terms of shipping products and potentially minimizing certain aspects that we're experiencing now of supply chain disruption. So I think robotics and artificial intelligence, a very important area. Another area, video games and esports. Sounds kind of funny, video games. How big of a deal can that be? The video game and esport industry, sector, subsector, theme, whatever you choose to call it, is bigger than the movie business. So video games continue to expand their audience. They add different features, and the space is emerging as potentially the next generation of the internet. And this is where the metaverse comes in. So just imagine a metaverse, an enhanced virtual reality world where there's millions or even potentially billions of users interacting with each other and buying things. I think about my son who plays Fortnite. He's constantly asking me to buy V-Bucks so he can buy skins and dances and things that I'm like, really? You're buying nothing, of course. But these companies, Epic Games and Sony, are making a tremendous amount of money. And then traditional sports, you think about traditional sports, it's kind of a limited way to experiencing something. So watching a game, watching it on TV, watching in person, it's just you and the game interacting. Maybe you're hanging out with some people in the audience. But video games is, and expand that to esports, provides just a lot of functionality. Just think about it. You can interact with your friends who are across the country, across the world. You could interact with famous gamers. I'm sure you're going to have to pay money to be in their virtual presence. And you get to watch this high level of competition, connecting with all different fans and your gaming chair in your gaming room. So this is an area where I think is the future. And the metaverse is intricately involved with this sector. And then there's cloud computing. All of this is not possible with a cloud-based infrastructure. And you need the software to offer this great flexibility and provide some predictability and scale, which it does. And the cloud business is just a great business. It's a subscription business that offers a steady cash flow. And the pandemic accelerated cloud adoption, and the cloud proved its effectiveness.
Sure, these are all very interesting themes, and these are all long-term investing themes, which will benefit from these changes in the preferences of society and the changes in the economy. So if you look at the short-term performance, last year's performance was pretty, disappointing for some of these themes. And your favorite thematic ETFs for this year, I understand, are the robotics ETF, ticker symbol BOTZ, the social media ETF, ticker symbol SOCL, the fintech ETF, ticker symbol FINX, the video gaming ETF, ticker symbol HERO, very easy to remember, and the cloud computing ETF, ticker symbol CLOU. Now, all these ETFs are down between 18 and 38% over the past year. The social media ETF is the worst performer, and that is mostly due to this dramatic plunge in share price of Facebook that we saw after they reported their results. The stock plunged more than 26% that day. So talk to us a little bit about these ETFs in particular, why these ETFs are likely to do well in 2022.
Well, first of all, we always talk about performance for thematic ETFs from a longer term perspective. So you're seeing a disruptive change in trends over time, and yeah, the pandemic was unique. You know, we saw a period of time where we all were sitting home, and many of the themes that we're talking about today saw a big shift up in terms of adoption, from financial technology to cloud computing to cybersecurity. All of our data is out there. We need it to be protected, to social media to interact with friends. And so you saw that big acceleration in returns in a short period of time. As markets began to open, there certainly was a change in leadership in the market. And you add on top of that some of the concern about the impact of rising interest rates, and how that will affect your stock price, because your stock prices will be discounted because of, the formulas, basing it on higher rates. That doesn't take away from the adoption of many of these different themes. And while I do believe in the near term, the focus should be on profitability, as well as predictability. So based on that, we have seen some pullback. There's varying degrees of profitability within some of the theme-based ETFs. Many of the companies are profitable. Certain themes have less profitability than others. But thinking about how to use thematics in a broader portfolio, I think, is the important question. And what I believe is that it depends on your risk tolerance and time horizon. Now, we build asset allocation models that we use some component of thematics. Now, a moderate investor is going to have a different risk profile than an aggressive versus a conservative. So there's varying degrees of exposure that I think should be included in an overall portfolio. But what I do believe is that the disruption will continue. You think about FinEx, financial technology. Financial technology is, you're seeing companies that are, whether it be they're blockchain related or miners, or companies that are providing digital payments or cloud-based solutions on the financial side, or buy now, pay later. Some of these companies are going to be incorporated into the existing financial services business. Other companies are going to take over the financial services business. You think the blockchain will certainly impact the financial ecosystem over the next 3 to 5 years. So my point is that these themes are going to be absorbed into the broader economy, and in the broader sectors, excuse me. And I think they're important, and over a 5 to 10 year period. And I think that's how you have to view thematics. I think we're a little bit spoiled because of the past couple of years, because of the fast acceleration, because of the pandemic, because we had to adopt many of these themes to operate effectively while sitting at our homes. So there was a change in leadership, and doesn't mean the adoption is abating.
Yeah, these are all very interesting areas with a lot of long-term growth potential. And one area which I would be watching very closely is video gaming, and particularly Microsoft's planned acquisition of Activision Blizzard, which Microsoft described as a pathway to the Metaverse. And if this acquisition is completed, this would be the biggest acquisition by a technology company ever. And I saw that GlobalX has also filed for a Metaverse ETF, and Metaverse is such an interesting theme currently. So I'll be keeping an eye on that ETF as well. Now, shifting gears a little bit, I wanted to talk a little bit more about the role of thematic ETFs in a portfolio. And you mentioned a little bit about their role and how they fit in an investor's portfolio. Could you expand on that, and what risk should investors who want to invest in these themes should be aware?
Yeah, it's a good question. And just to, the metaverse is something that, just before I answer that, the metaverse is an area that everyone seems to be very interested in entering virtually, I guess. And the big players are uniquely situated because they can certainly purchase other firms that are already starting to begin moving into the metaverse and devote lots of capital to build out that world. So I think that's something that's an area to really look out for, and it's going to touch a lot of different themes. Now, thematic equity, I think, is best suited for longer-term investor. You have to have a longer-term investment horizon, as I mentioned earlier. Investors who believe in the idea and remain invested in the concept, I think will be rewarded over time, because many of these novel ideas will be ubiquitous over time, and some have already become so. But diversification remains very important, and when you're putting different themes together, you are getting some diversification. So many themes can't be neatly packaged into one particular sector or another. They tend to be more technology-based, but not all technology. So they do touch healthcare and industrials and materials. And so there is a component of diversification. Now, that being said, I think a purely thematic, technology-based thematic portfolio should be thought of as part of a larger portfolio, a satellite exposure. I would never recommend to buy only a thematic portfolio. I would add it on to your existing asset allocation, whether it be your typical 60-40 portfolio, or you just carve out of some component of your equity-based exposure if you're not overly interested on the fixed income side. Because we have developed asset allocation models, as I mentioned earlier, where we include limits on the maximum amount of thematic equity that we believe is appropriate for a particular risk profile, from the conservative portfolio to the aggressive portfolio. And that I believe that is an effective way to manage risk in using this type of exposure.
That's very helpful. That's all we have time for today. John, thanks again for joining us.
Thank you. It was a lot of fun.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@saks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.